Today's podcast is brought to you by Dalupa. Dalupa's database of over 2,500 models contains the most KPIs for each company, along with non-GAAP adjustments and guidance specific to the business and the quarter. Clients use Dalupa's existing data to construct their own models faster and ramp up on new names more readily. Coupled with Dalupa's plugin, which automatically updates numbers and formatting within your model, you'll never need to input numbers manually again. All of Dalupa's data points are contextual, audible, and accurate. Their AI algorithms allow them to collect the most data on their companies at the greatest speed and build out their model database at a rapid pace, while their final layer of human analysts ensures total accuracy of their models. You can even update KPIs for multiple different companies in an industry model that allows you a bird's eye view for better idea generation. Save time with Dalupa to do more value-added work. No more data errors, no more Excel monkeying, just the fundamentals, all at your fingertips. Hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. If you like this podcast, it mean a lot if you could rate, review, subscribe wherever you're watching or listening. With me today, I'm happy to have David Bastian. David is he's a CIO over at Kingdom Capital. They've got an active Twitter account. They've got an active Seeking Alpha account, which I really think you should follow. He posts some really interesting ideas, one of which we'll talk about today, but I'll pause there. David, how's it going?
Doing well, Andrew. Thanks for having me on today.
Hey, thanks for coming on. Let me start this podcast the way I do every podcast. First, a disclaimer to remind everyone, nothing on this podcast is investing advice. Please consult a financial advisor. That's always true on this podcast, but today we're going to be talking about a stock that, it's not the smallest stock ever, but it is pretty small. But the bigger thing is it's on the pink sheets. It's relatively illiquid. And everybody should just remember that comes with extra risk factors. There's extra illiquidity issues. So again, please, not an investing advice, consult a financial advisor. Second, a pitch for you, my guest. I've been following you for probably 5 months or so, and you're just banging out one banger idea after another over on Seeking Alpha. Read your Q2 letter. I mean, this is the one that I think I found you from, but there's a ton of other interesting ones. We can talk about WTI. We can talk about some of the other names, but yeah, look, I've just found you to be a great source of ideas. It's been good getting to know you over the past couple months, and I'm really excited to talk about this one. So all that out the way, let's turn to the company we're going to talk about. The company is Unit Corp. The ticker is UNTC. I'll remind everyone, pink sheet stock, so you can buy and sell it pretty normally, but it is going to be more illiquid. I'll turn it over to you, though. What is Unit Corp and why are they so interesting?
Sure. Thanks, Andrew. So Unit Corp is an oil and gas company based in Oklahoma. They've got 3 main segments, so they're a little more diversified than a pure play production company. Unit's first segment is their upstream, where they do oil, gas, and natural gas liquid production from their various wells in Oklahoma. And their second segment's the midstream, where they actually process and move a lot of the natural gas and oil out of their properties in 2 various refining locations. And then lastly, they've got a rig segment where they actually do contract drilling for other producers to help them open up new wells. Unit was looking at a sale process for their upstream segment earlier this year that they recently terminated. That was one of the things that got me paying attention to it. And so now they've kind of committed to being an operating company here instead of potentially kind of winding up most of their properties here. So that's a very high level overview. The company's trading about a $500 million market capitalization right now. And they're looking at close to $200 million of cash on their balance sheet after a sale they closed at the beginning of July. So it's about a $300 million enterprise value from where we're trading today.
Perfect. I think that's a great overview. And, I think the most important place to start with is the sale process, because I know myself personally and a lot of other people, we got involved here because in January, Reuters runs a report that says, hey, Unit Corp is looking to sell themselves, and Unit actually puts out a press release. And if you emailed the company, they would send you even their sales deck. But Reuters runs a report that says Unit's looking to sell their assets, and they're hoping to fetch around $1 billion for selling their oil and gas assets. And myself, a lot of other people did that math really fast, and we said, hey, Unit's market cap is $500 million. They're looking to sell their oil and gas assets for $1 billion. And they've got 2 other assets in there that, they can't really be worth negative. So yeah, this is a double on the oil and gas assets, and you get everything else for free. And I think a lot has changed since then. But the biggest, if I just told you that story, the biggest headline change was they came out about a month ago and said, hey, we're calling off the sales process. We're just going to be a standalone. We're probably going to return a lot of capital to shareholders, which I'm sure we'll discuss. But if I told you that whole thing, I think my first pushback would be, oh, cool. Well, they want us to run a sales process. Nobody wanted to buy them. Overvalued. Like maybe $1 billion's overvalued. Maybe it's only 700 million. But they looked at, can we get proceeds that are greater than our market cap? And the conclusion they told the market was no. So why is that interesting? I'll pause there.
Sure. So yeah, I think the interesting part, you mentioned that they were sending out the sales deck back in January when they launched the process, and they put out an estimate that the present value of their assets in the upstream segment at a 10% discount rate was around $760 million.
Yep.
So that initial $1 billion estimate, I think a lot of people looked at that and said, oh, that's probably optimistic. And, like you and I looked at that and said, well, even if it's optimistic, there's plenty of room for that to be optimistic and for me to make money here. And that was when oil was trading at $80 a barrel and natural gas was $5 or so. And since then, we had the Russian invasion of Ukraine and prices have really exploded. So, fast forward a little bit and that.
If I can just hop in there, because I follow this stuff pretty closely. So the day that they priced the day that they put their deck out, the strip that they used, let's drop 2022 because 2022 prices can fluctuate wildly. The strip they used, oil from 2023 to 2030 was averaging $63 per barrel and gas was averaging $3.30. And as you and I are speaking, oil is averaging $75 per barrel and gas is averaging $5, right? So we are talking an enormous increase in not near-term energy prices that are factoring in like a short-term squeeze or something. These are long-term strip prices. We're talking about a massive increase.
Yes. And that's exactly where the thesis went from, hey, this is probably worth a lot to this is worth way more now at strip. And if you even go back to, all right, well, if prices do go back to 50 a barrel and $3 gas, you're still looking at, like you said, when January, a $750 or so million asset at a 10% discount rate. And that's also ignoring future production gains they could do in the other two segments of the business.
Yep, that's perfect. So, look, but I do want to circle back to if their assets were so valuable, why couldn't they get a bid that was approaching their value, or a bid that, we'll talk about the illiquidity and the major shareholder in a second, but a bid that at least got the board to say, well, we're trading for 500 million. We think we're worth $1 billion, but we got an $800 million bid. And, maybe it just makes sense. Take the bird in the hand versus the two in the bush. We can talk about the bankruptcy later. They emerged from bankruptcy 2 years ago. Like, this is a home run result for everyone. So why do you think that sales process didn't kind of work out?
Sure. Yeah, I think from what we've been seeing, there hasn't been a lot of M&A in oil and gas in the last few months, especially since prices really went up. And it seems like both buyers and sellers are kind of sitting on their hands trying to figure out where things are going to settle. I think in a chaotic environment like that, you don't really want to be a buyer necessarily. It could work out great for you, but if you bought when prices were up at 120 and 9, a couple months ago, you'd already be a little worried about, what numbers you were paying off of. And, if you're buying here today, it could end up looking really good or really bad. But the volatility day to day here is high enough that I think when I had spoken with the company, I got the impression that there was just a very significant bid-ask gap, as it were, on properties right now, with a lot of companies being unwilling to pay prices that might end up looking bad in a very quick time frame, and they want to see some more stability first.
Yep. No,
so, I guess that's long short is you're just not seeing anyone that wants to pay the PV10 values in this environment.
That's my take as well. And UNTC is not the only company that has tried to engage in some asset sales, asset swaps, that has told me, hey, we brought these assets. They're I'm not saying they're the best assets in the world, but they're certainly not the worst assets in the world. We brought kind of average assets to the market said, hey, here's these assets, and every bit, like, here's the PV10, and would we take PV12? So PV10 is their present value of the cash flows discounted at 10%. Would we have taken PV12, so discounted 12%? Maybe, but every bid we got was like PV20 plus a discount to the curve, right? So if oil is at 80, they were pretending oil was at 70 and bidding that a 20% discount. And they were like, look, at those prices, we just think we'd be giving them away for free. Like we can't do that. And again, that's what I think UNTC found. And I've talked to several oil and gas companies who have run into similar issues. So I think it is pretty credible, and it kind of makes sense, right? If you're a bidder and last year gas was $3 and now you're getting asked to pay gas $7 prices, it's a little tough to think that gas is going to stay around there.
Yeah. No, and that's where I really appreciate that the company has started. They started hedging their production that they had that was left floating around $100 oil and $9 gas. So I think they've looked at this as, well, we'll make some cash here and then reassess kind of as time goes on and actually develop these assets.
Yeah, I agree. And for those who are listening, so in maybe a week ago, I think Dave and I actually started messaging around and decided to do the UNTC podcast on the heels of it. But a week ago, they came out with, hey, here's our preliminary Q2 results. Here's our balance sheet. We've started buying shares back again. And we're going to talk about share buybacks at some point. But I think all of that was great. But the thing that I was really positive on was they had stopped their hedging process completely late last year, early this year, while they ran the sales process. And once they called the sales process off, they started hedging again. And prices were obviously, very high over the summer. So they were getting crude oil hedges done at $95 per barrel. They got some nat gas hedges done at $9 per MBTU or whatever it is. And, I've written about this on the blog frequently. There are so many companies that were hedging when gas was $3 last year. And now that gas is $9, they're not hedging. And you're like, hey, like, you can either hedge or not hedge, but what I don't want you to do is hedge when things are bad and then not hedge when things are good. And it was nice to see them go right back in the market and start hedging again. I'll pause there and let you add anything, comment. Did I miss anything?
Yeah, no, I think that's a great point. And just, those relatively small oil and gas hedges for the next, 9 to 12 months adds about $70 million of revenue they're going to do just from those hedges. So I think one other aspect of that is that you saw their realization on gas in Q2 dropped a little bit versus Henry Hub. So traditionally they get a slight discount to where gas is trading just based off of being able to move it and contact timing, things like that. So I also like the fact that hedging at 9 kind of removes some of the risk from where they're going to realize. It's all right, we hedged it at 9, whatever, we're going to get $9. So they're definitely de-risking the situation. As we talked about earlier, the enterprise value right now is around $300 million. So locking in $70 million worth of revenue when your production cost is $6 a barrel of energy, it's pretty much 100% margins when you're selling it at 100. So yeah, I think that being able to do that selectively, and then you sit down next spring and say, all right, where's the strip at? Let's hedge a little bit more. I think it makes it a very safe investment versus some of these unhedged producers that I think are maybe more popular in a rising price environment, but get killed on the way down.
Yep. I hear that because I've written about it. We were just talking about it. There are so many unhedged producers that if you run the strip, they look so undervalued right now, but you are taking strip risk. And I personally don't know a good way to hedge strip risk, especially on nat gas. I don't know a good way to kind of hedge that out unless you are a producer. And the nice thing about a producer like UNCC that's hedging and they're doing it when prices are high is that risk starts to evaporate. Anyway, we've talked about the sales process, which I think is question number one on, it's going to be question on number one on anyone's mind who's new to the story and is just diving into the story. But I want to step back. My first question I always like to ask is, we're going to dive deep into lots of stuff. We already dove deep into some things, but look, market is a really competitive place. Even for an e-liquid stock like UNCC, this is a $500-600 million market cap company. Like a lot of people get in here. When I talk to oil and gas people, like many of them do know this company. This used to be a much bigger, more liquid, publicly traded company. So this can be found if people are looking for it. So market's a public place. why is UNTC, what is the market missing that you're seeing, that I'm seeing, that makes UNTC a compelling investment that will generate risk-adjusted alpha going forward?
That's a great question. Yeah, so I think, like you mentioned, it is on the pink sheets. People are aware of it, but it's definitely harder to get a position in terms of the trading volume. One of their legacy holders out of the bankruptcy process, Prescott Group, owns over a third of the outstanding shares. There's two other holders that have about a 15% position. So over half the stock does not trade. So there definitely are people who would want to take a position in this, where getting the shares to go with the daily volume is sometimes in the 1,000, 2,000 share range. It is tough to get in and out of, and for those that want to maintain some liquidity, this might not be the name for them. For a fund like us, where we're managing about $5 million, liquidity is still such that if we wanted to blow out a position in a day, we'd have to probably realize a loss. It may not be substantial, but that definitely creates some risk around trading the stock versus you don't get much smaller than we are when it comes to being able to get in and out of stuff like this. So I understand that. We have a longer term focus. We're willing to bear some liquidity risk in exchange for what we see as undervalued stock. But if you wanted to go out, and I think one of the best comparable stocks on this is Sandridge Energy, that's also based in Oklahoma and has pretty similar profile production. If you wanted to go invest in that, you'd be able to get in and out. You get an options chain that you can use to hedge your risk in the stock if you wanted to, say, buy puts on your position. Unit doesn't have that, and it has some pretty concentrated ownership. So I think that's one of the risks. People don't like the hedges because it does remove some of the upside. If gas goes to $20 next week, Unit's not going to see much of that. They could layer in some new hedges, but
no, I'm 100% with you. People don't like the hedges and see liquid, but you mentioned Sandridge, and I know a lot of people who think Sandridge is very interesting. I've looked at it. I've done the math on it. If gas stays here, it's going to be really interesting, but you're exposed to the gas downside. And I do feel like Sandridge, actually, because it is such a pure play, it is so unhedged, and it is kind of cash rich. I do think Sandridge trades it's probably the most expensive on a mark-to-market basis of any of the energy companies I know. Now, that's not saying much, but it probably is the closest to their fair value of the PV10. I think I'm just talking a little bit out of, but I think I would stand by that. I'm kind of looking at a simple model app. Anyway, you mentioned one of the key things I think about UNTC. Prescott Group, who owns over a third of the company. After the buybacks, they probably own about 40% of the company. And look, I don't know how much they're running, but if I did the math on kind of their last 13F and everything, I think UNTC is a mammoth position. You've got to remember UNTC, we can talk about the bankruptcy in a second, emerged from bankruptcy. I think they got their stock from the loans, and the stock's a 10X since then. So it was a big position, that 10X. It's now they're kind of a UNTC, if I'm right on their AUM, they're kind of like a UNTC book with a couple of other things on the side. So this is a huge position for them. And I think the thing a lot of people wonder is, what does Prescott do? Because if they're going to try and sell on the open market, they're going to crush the stock. I know for me, I always thought they might want to take a bid in the process they just ran, even if it wasn't quite full value, just because they looked and said, hey, this is so much of our book. We own 40%. The only way we get out is a sale. So even if we're selling for 70% of fair value, if it realizes a mark above where the stock's currently trading, let's just take that, get the cash and redeploy it. So I think they're really critical here. And I just want to hear how you think they interact with the company, what their plans are.
Sure. Yeah. And I'd be honest, I've not talked to Prescott. I do not know what their intents are with the business. So any serious comments there, it's just going to be speculation. My impression is that they had a pretty big loss on the bonds going into the bankruptcy process, and their stake there, and that they've, like you said, they've done great on the stock coming out of that. They are one of the reasons the hedges exist, is my perspective, is that they're trying to add in as much as they can to de-risk this situation. I think one issue that we'll run into here is that there's a lot of net operating losses at Unit Corporation that came through that bankruptcy process, which allowed them to avoid paying taxes at this time. And were the business to be sold, and were Prescott to trip over the 50% ownership threshold, those NOLs will be put in jeopardy. So I think that there's an aspect where they're kind of content to sit tight right now and maximize the value by not doing anything. Once those NOLs are out of the way, once they've been used up from their income they're generating right now, I think that would maybe open the door for them to do something else. But the most value right now at Unit is realized by having those and not tripping any change of control provisions and causing those net operating losses to go away.
Perfect. And just one more quick question on Prescott. Look, Prescott has a member on the board, right? And I'm sure Prescott has a member on the board, and the board knows Prescott owns 35, 40% of them, whatever. But just to confirm, like, do you think Prescott, when the company when the company ran this process, looked at the bids and said, "Hey, we'd rather stand alone than hit any of these bids," do you think Prescott kind of blessed that strategy and said, "Yeah, you're right, we can make a lot more money, even though this is a mammoth position, we're all in, let's pursue our strategy"?
It seems like they would have. I'd be surprised if they were strongly opposed to not, rejecting the bids and moving forward. And then they did it anyways, given their ownership stake. So presumably this is what they're blessing, and they believe that they can maximize value this way. So I think we'll see how that goes. I think it seems like Unit was at a bit of a crossroads here, where they have the upstream sale process that was ongoing. We haven't gotten to the midstream yet, but their partner on the midstream can force a sale of that asset in early 2023. So the company was kind of looking at, depending on what bids we get here, we can kind of sit down and say, here's what we think midstream's worth, here's what we got on upstream. And then we have this rigs business that probably doesn't make sense to remain a company on its own. So we can either kind of just look at breaking this up and selling everything, and here's the pile of money we have left, or we can choose to run this as an operating business. And it seems like their choice has been, let's operate this business and go, generate cash flow that way. And they think they can end up with a bigger pile of money in the end doing that.
Perfect. Let me ask one more question on the upstream sale process, and then we can move on to then we'll probably move on to value in upstream and value in all the other segments. But I do want to ask one more questions. So as part of the sale process, UNTC said, no, we're not going to sell upstream, but they did sell one piece of the business, and that was their Gulf Coast assets. And their Gulf Coast assets, at when they were marketing this, so January 11th, they said the PV10 for these upstream assets was $69 million. And as I talked about earlier, PV10 is way, way up since then, because gas prices, oil prices, everything has risen so much higher. And they ended up selling the Gulf assets. They said, hey, we're not selling all of upstream, but we are selling our Gulf assets. If I remember correctly, they sold them for $69 million. But they also sold the Gulfstream assets I keep saying Gulf. They sold the Gulf Coast assets with an effective sales date of April 1st. And they're going to close that July 1st. So all the cash flows from April 1 to July 1 will go to the buyer, not to the seller, right? And that is going to be a lot of cash flow, because again, gas prices were going parabolic during especially in April, May, a little less June, but they were way higher. So they sold them for, I think it was 64 million was the price they sold the Gulf assets for. No, was it 54 million? They sold them for less than PV10, and PV10 had gone up a ton. And they sold, it's less than the headline number because there's 3 months of cash flow in there. So it was 56 million was the number. I'm looking at the right spot now. So I just want to ask, 56 million headline number, actually less than that when you factor in the cash flow. And that's a discount to PV10 and an even bigger discount once you factor all that in. Long-winded way of saying, should we look at those Gulf assets and say, oh, maybe these assets aren't even close to as attractive as thinking? Nobody sells assets for PV10, but they probably just sold the Gulf assets for PV18. Maybe these are PV18 assets.
That's a great question. And I think that is, as you mentioned, one of the other overhangs that people are looking at and making them question what the value is here. We've gone through the sales deck. The Gulf assets are their highest decline assets that they had. They're also the only non-core assets. When you look at where their other properties are located, the Gulf assets are not central to Oklahoma. They're on the southeast coast of Texas. the type of wells that they have on the Gulf are, like I said, higher decline, and they're, again, this is me as a generalist understanding them, but essentially they're a kind of well that can die at any moment, as opposed to being a more conventional slow decline well that you would run into in a lot of other drilling regions. So they're not as attractive as an asset. In terms of, my personal perspective on what Unit is looking at here is that they want to do some more development. They mentioned it in their Q2 update that they want to drill some more wells. But my understanding is they were not going to do it in the Gulf Coast region, just given that's non-core. It's not what they're focused on, and they are very high decline wells. So the production was dropping about 30% a year there. So the present value is skewed to the now. Like you said, there's a lot of cash flow that came out of them in the second quarter, and it won't be there going forward. But the company is getting some cash and able to deploy it towards developing their other properties and towards returning it to shareholders. And I think they knew they weren't going to be developing these properties if they kept them. So it's better to get something for them now and focus on their core operations is, again, my perspective. I would have liked to see a higher price, but I'm not sure that the property is as good as it might seem from first glance.
Perfect. That makes total sense. Just on upstream. So we've talked about the past, we've talked about the valuation here. I do want to talk a little bit about the future. Look, gas, as you and I are speaking, $8 to $9 for 2023. It's over $5, maybe $6. At those levels, I don't think there's a single natural gas field in the United States that it wouldn't be economic to drill and produce gas on, right? And especially a lot of UNTC stuff is, it's not as low cost as like an EQT or something, but it's going to be very profitable at those levels. So the most frequent question I get, and there, honestly, I have struggled the most with is, hey, can they increase production next year, right? Can they increase drilling? Can they go on a drilling spree? Could we be thinking, oh, this is a company, could production go up 8% next year? Could they increase production 20% over the next 3 years? Like, do they have the acreage? Can they drill? Like, what are their plans for CapEx there?
Yeah. So again, circling back to their sales deck, they indicated there is significant opportunity to increase production from their acres. They own their own drilling rigs, so they have an opportunity to do that in-house if they see it as being higher return than trying to contract those out to other producers. So they have a lot of optionality there. I think the most interesting part of that optionality is that because they have this midstream asset that, again, I mentioned is looking to likely be sold next year, they can drill acres connected to that asset to help increase the value of the throughput on the midstream prior to that sales process. So I think they have a very interesting matrix there, being able to potentially use their own drilling rigs to drill their own acres to increase their own midstream asset valuation and kind of have a rising tide lift all boats. I am not an expert in exactly what they're going to produce out of some of these new wells. I'm looking at it as if they were to not drill another well from here until eternity, I think I'm going to make more than my investment back here, and I see some upside from being able to produce more. But I'm not sure if they're going to be very aggressive on that front, again, given our understanding about a relatively conservative capital allocation strategy. I think they're going to try and identify the best opportunities. Again, they mentioned in their Q2 update that they have an inventory they want to drill. I just don't think it's going to be a particularly aggressive growth program that you might see from some other producers.
Yep. And just to what you're saying, like, look, these aren't the lowest decline assets ever, but I believe the blended, especially once you take the Gulf Coast assets out, which, as you said, were declining pretty quickly. I think the blended average of their decline is like around 10% for all of their assets. Maybe
I've got 10 to 12.
Yeah. It was 12% before. It was higher than that before they sold golf, but without golf, 10, 12, whatever. But that's not a crazy decline curve. That's reasonably low on the scale of things. And if you run 10% decline at this strip on these numbers, like, you're going to make a decent bit of money. I think we might circle back to oil and gas in a second. I actually have other questions to ask in depth, but I do want to move to the other two segments because those are key segments. They're certainly not worth as much as oil and gas, but there could be a lot of upside to either of them. So I think the place that makes the most sense to start is, you just mentioned they own their own rigs, right? And They own, it's what, 17 Boss rigs, which are new generation rigs, and I think they own 7 or 8 old generation rigs, which are kind of a little more spec. But if you're following oil and gas right now, there is huge demand for equipment, right? A lot of equipment got mothballed with prices, as we've said, with prices where they are. It's really economic to drill. Rates for rigs are going up really quickly. So when you look at the last 12 months for their rig segment, you see, what is it? I've got LTM as of Q1, so this is a little stale, but LTM as of Q1 EBITDA was 14 million. But their new rigs that they're leasing are going to be coming in at like $30,000 per day versus it was like 17,000 last year. So you're going to see profits ramp up here really quickly. I've kind of thrown it all out there already, but I want to ask you on the rigs, where do you see the cash flow going from rigs? Where do you see the value? And if you want to add anything to, I'm sorry, I just said the whole outlook, but if you want to add anything to that, I'd love to hear it as well.
No, that's a great overview. So I think first, if you just go look at the Boss rigs that they have on their own, as you mentioned, these are valuable rigs. They're pretty high spec. They're new, shortly before everything really started imploding here in 2020. Those rigs, if you go listen to H&P's call, they'll tell you that rigs like that should be doing around $30,000 a day at current contracting rates. In Q2, Unit did 21,300. So right now I'm seeing, almost 40 or so % upside to those rates as the year progresses. And, hopefully by the beginning of 23, we'll be seeing around 30,000, running through that segment. So, if you do the quick math on 30,000, running through rigs versus the current 21, I mean, they did about 33 million of contract drilling revenue in Q2. And so you give that another bump, you'll be looking at hopefully somewhere in the 40 to 45 million range of quarterly revenue there. On the expense side, they had about 26 million in Q2. So on one hand, there's going to be inflation pressure there, but on the other hand, there's also some activation costs as they've been getting those up and going in the first quarter, second quarter. So I'm cautiously optimistic that number is going to go up with inflation about as much as it's going to go down due to the one-time costs dropping out. So if we end up in a place where they're doing 40 to 45 million of quarterly revenue from rigs and their costs are around 25 million, then they could be doing more than 50 million a year of rig cash flow between now and somewhere around middle of 23.
So you said $50 million of cash flow between now and somewhere in 2023. I don't have huge quibbles with that number. I think I might be a little lower, but we're starting to split hairs and small changes in day rates because day rates drop literally straight through to the bottom line. So I think that's right. But let's talk look, 10 million shares outstanding right here, right? You just said 50 million of cash flow. We can do that math real easy. That's $5 per share value on a $58 stock price. But we're kind of talking about, right now rigs are really in demand. We're kind of talking peak earnings levels. So how do you, everybody can just see my background there. How do you look at the valuation for rigs? Because it's something I've struggled with, right? Like, what's a mid-cycle earnings number? These things are just like mid-cycle earnings number. We're obviously going to have a great cash flow number. What do you think?
Yeah, I think that's a great question. So I think first, if you looked at the cost of going out and trying to build one of these high spec rigs right now, we could fight over the exact number, but it's probably in the neighborhood of $30 million. Give or take, if you want to get a new one right now, you'd be looking at something in that ballpark. So if you take that times 17 Boss rigs, you're looking at a new build cost here of over $400 million to try and replicate what they currently have.
Let me just pause you right there. So don't disagree with any of that math. I've heard it from them. I've heard it from others who I've talked to. Don't disagree with any of that math, but you do have the issue of depreciation, right? So these rigs, I think the last one they built was 2018, and some of them are earlier than that, if memory serves. So these have been gently used. I'm sure they're getting lots of TLC and everything, but you said that 400 million number, which again, 10 million shares outstanding, that's $40 per share. That's massive. Combine that with the cash on the balance sheet and you're basically getting upstream and midstream for free. But we haven't factored in that depreciation. So how would you say these nicely used rigs would kind of compare to that new build cost?
Yeah, and that's where I would ballpark that if they wanted to go, fire sale lease tomorrow. I mean, I haven't seen much transacting on the high spec side. I don't think anyone's really trying to sell rigs right now. Going into like what you said is probably going to be a very interesting cash flow cycle. Again, if you use 15 million, you still end up getting pretty close to the remaining enterprise value they have right now after their cash. So 15 times 17 still gets you in a pretty good place. If you want to say they went and sold them for half of the new build cost, might be a little more, might be a little
which
less.
seems pretty draconian to me. Just again, I'm not an expert on the shape these things are in. I think they've kept good shape. I think they've got pretty long lives, but 50% of to build cost seems quite draconian to me.
Yeah, and if you go look at independent contract drilling, ICD is a ticker that has a pretty similar rig fleet and is being valued at a couple $100 million. It's kind of tough because it's mostly an equity stub with a lot of debt. But that's an interesting one to look at if you're trying to track day rates and valuations as well. So I think there's support out there that if all you have is a pure play rig operation here, that you could still come up with 200 to 300 million of value if you just tried to sell this current operating unit. And you could argue that it's going to do 50 million plus of cash flow in the next 12 to 18 months.
I have not looked at ICD, but that we'll have to throw our disclosure out 100 different times, because if Bloomberg's telling me right, it's a 50 million market cap with 125 million of debt. So there's obviously a lot of risk that comes with that. But that does look pretty interesting, because when you combine a lot of leverage with a big up cycle, the cash flow numbers can get juicy pretty quickly. But please, I've done no work there, so everybody go do their own work. No,
yeah, to be clear, I do not own ICD. It's just an interesting comp.
That makes total sense in the contract drilling. Let me ask one other question. Again, we've talked about how Prescott owns a ton here. They looked to, but didn't sell the upstream division. You've got this drilling segment, and you could argue, oh, there's synergies. We own drills. We might drill our land. There are synergies there. But I think you could also argue, you don't need to have drills and upstream under the same segment. That if you want to drill, you can go find the best rate. If you want to be a driller and lease yourselves out, you should go find the best rate. Like it just makes total sense. So could these segments, question 1A and 1B, could these segments be split apart? And why do you think the company hasn't pursued that so far?
Yeah, well, I mean, I think that they're going to be split apart based on, if you read the latest financials, 50% of the midstream segment is owned by Partners Group, which is a private equity firm. And in May of 2023, they will have the option to force a sale of that segment.
Hey, David, sorry, just to be clear, I wanted to talk about drilling and upstream together. I was going to go to midstream next, but I was just saying, could drilling and upstream be split apart?
I mean, I think that, based on the sales process they just ran, they looked at doing that and decided it was better to keep them together, is the simplest answer I'd give you.
Okay. Makes total sense to me. Hey, you're beating me to my next question, but they have three segments. We talked about upstream. We talked about drilling. The last segment is midstream. I'll let you started. I'll let you continue there. And I've got some thoughts I can throw in, but I think you're probably better suited to talk to this than me anyway.
Well, we'll see. So Partners Group owns 50% interest in their Superior Pipeline operating segment. The ownership interest is a preferred interest, so Partners is entitled to a 7% preferred return on their $300 million investment from 2018. They will be hitting the 5-year mark on that in April, and that's the point where they have the option to force a sales process. So given that, private equity generally works with about a 5-year holding period for things like this. So my expectation would be that Partners, when they get that option, would then look to sell and get their investment back for their LPs. I have not talked to Partners, so I don't know what their intent is, but that's what I would expect. Based on kind of some industry numbers that I've seen on that, I think if that were to happen, the sales price would be pretty close to Partners' preferred interest as it stands today. Their 7% hurdle gets them to about a $350 million preferred return right now. Unit disclosed their Q2 cash flow out of Superior was about $15 million. So again, if you want to assume we're paying peak earnings there, they're probably not going to get a huge multiple. So $60 million on a $350 million preferred hurdle. You need about a 6x to start getting over that valuation. So my guess would be, looking at Midstream, that Partners probably forces a sale next year, and that sale is somewhere in the neighborhood of their preferred return, give or take.
So I don't disagree with anything you say. What I was going to add on is I think Midstream is the area, as I've done more work and gotten to know the company more over the past, since whenever I invested in it and started following in it, it's the area I've become most bearish on. When I first started doing this, I did the math you did, and I said, oh, well, it's Midstream assets in a great environment. These tend to go for around, 10x is kind of your rule of thumb. I think if you go back to the 2018 deal, I think these were valued at like 10 or 12x. I can't remember exactly, but as I've done more work and kind of gotten to know the assets a little bit better, talked to some people, I think you're right. And the difference is material, right? Because if it's a 10x, this is worth $10 per share or something to UNTC. If it's a 6x, it's worth about nothing. And I've increasingly come to say, hey, maybe you'll get a couple bucks from this, but I don't think there's a lot of equity value there. Would be happy to be proven wrong, but that's where I've come out to as well.
Yeah. No, I think it's an interesting call option. I think that, you can keep in mind that 350 million hurdle is going to go down in the next year as they continue to pay cash distributions back to Partners Group. So hopefully that number is closer to 300 million next year when they force a sale, if they force a sale. And if that were to happen, it gives you a little bit more potential for upside here. But I'm not looking at this thing assuming they're going to go sell it for 500 or 600 million and that Unit's going to get a huge return. I think that the incentive here is tough because I think Unit would like to go try and build this out a little bit and try and add on some more pieces if they could. But I doubt Partners is going to want to take on much more risk in terms of spending some cash to actually go and try and really build a larger asset right before they go into a sales process. So I don't really expect much movement on that front. It could be wrong. They bought some assets at the end of last year at what seemed like a pretty attractive multiple, but
the only pushback to that, and again, I do not disagree with that, but the only pushback to that would probably be, hey, again, this deal was done in like 2018, and I think the implied valuation was about $600 million, right? Which would imply UNTC's stake is still worth $300 million. It's like, well, the energy environment today is a lot better than 2018. Interest rates are actually probably a little lower than 2018, even after this year's run. It's hey, why wouldn't these be worth at least what they were worth in 2018?
If you go look at what Midstream assets are trading at right now, I've landed around a 6 to 8 multiple being more what the market value is on those. And when you try and get into what's the actual earnings power, there's not as much upside on the Midstream assets as prices go up. It's mostly fixed rates. There were some minimum usage payments that kind of rolled off at the end of 21 going into 22. So trying to get an exact trailing 12-month multiple on what they've been earning here is a little tough to nail it down. So essentially, I want to view it as a zero or close to it to make sure that I'm not baking in a return on that piece that ends up not materializing. I think if I get $200 million out of it, that'd be fantastic, but I'm not expecting that.
Cool. I think we've hit each segment. I think we've done a pretty nice job hitting each segment. I want to do a sum of the parts, and then I want to talk about likely capital allocation going forward. But before we hit either of those, I just want to ask, we talked about a lot here. Is there anything I glossed over you think we should be thinking about harder? Anything we didn't even talk about that you think we should be thinking about?
I think we've hit most of the main points. I think one of the interesting things will be, I didn't talk about this earlier, when it comes to lack of awareness, the company has done essentially nothing on the investor relations front in the last year.
That's what we're here for, big guy. That's what we're here for.
Yeah, if you go look at their press releases in the last year, there's been 3, maybe. They didn't even put one out with their first quarter earnings release.
No, it was so frustrating because I think, if I remember correctly, they buried the press release inside of the 10Q. No, they don't do that. I am misremembering. They just didn't put out a press release. But yeah, it gets pretty frustrating where they're like, hey, cash is literally flowing from the ground into our bank account. It's like, yeah, but nobody can see the press release. Nobody knows.
Yeah. So I think you do have to ask kind of who the incremental buyers are on a name like this. And I think until the company gets a little bit more investor facing, there's a lot of guys who maybe they look at it, but this isn't something that they would necessarily want to go invest in with a lack of traction. As you and I both know, it's great to find a stock that less people are paying attention to until you buy it, and then you want more people to pay attention to it, and they don't.
Well, incremental buyer, that brings us nicely to the next question, capital allocation, right? Because this company has done a fantastic job of repurchasing shares since they emerged from bankruptcy. If I'm just looking at the press release correctly, right now they've got about 10 million shares outstanding. They repurchased about 1.5 million shares since their bankruptcy. So they started with 11.5, they repurchased 1.5 in 15 months, and that's with a pretty liquid stock. And by the way, when they were purchasing in the first half of 2021, energy prices weren't anywhere close to where they are now, right? So they weren't generating anywhere close to a lot of cash. But capital allocation, 10 million shares now. We talked about how Prescott owns a lot. There's two other holders who own a decent bit of this thing. I'm sure they would love to buy more shares, but at some point you start to run into, hey, is the stock even liquid enough to buy more shares? So they said in their press release for July, they said, we're evaluating how to return capital. What do you think is most likely? Are we talking big dividend? Are we talking tender offer? Can they continue doing share repurchases? How do you think they're going to return capital to shareholders? Or am I wrong in they're saying they're going to do it and they're going to pull the classic oil and gas thing and say, oh, actually, we decided to do a lot of M&A?
Yeah, I certainly don't get the impression, looking at what they've been doing in the last couple of years with buybacks and very conservative capital allocation strategy, that we're suddenly going to see a M&A spree. I feel like you said, it's oil and gas, so best to be a little bit cautious on that front. My expectation is, now that the company is committed to continuing to operate, they're going to manage their upstream, they're going to manage the rigs, they're going to manage the midstream for as long as they own it. They were on a national exchange before they went bankrupt. I would not be shocked to see if they tried to uplist off the pink sheets again and try and actually get a little more investor focused here. The company hasn't publicly indicated that that's the next step. I am just hopeful that that will be something they will look at here. I think it would make a lot of sense. I think that would help with them in terms of investor awareness, incremental buyers, hopefully re-rating them closer to a multiple similar to peers like Sandridge or other producers in their area. And I think at that point, if I was Prescott, I would probably want to start being able to sell some of my stake, take some risk off the table, like you said, until it gets valued more in line with some of these other peers and to the substantial asset value that you and I are seeing here. I think they're content to buy back shares and pay a dividend. There is a bit of an interesting situation there, as we talked about with the buyback. They can only buy so much without endangering the NOLs with the ownership. So I think the dividend becomes more and more the focus, at least here in the short term. One of the other interesting upside, I guess, for the company is that when they pay out dividends here, there are about 1.8 million warrants outstanding from the bankruptcy process. Those warrants have a $64, give or take. It's like $63.70 strike price. And those warrants are not adjusted for dividends. So for the company, there's a kind of interesting capital allocation strategy here, where if they pay a lot of dividends, they kind of reduce the impact of those warrants on future dilution, because the warrants will not be adjusted down with the dividends.
Am I remembering correctly that Prescott does not own any warrants?
I'm not 100% sure on that. I haven't seen any evidence that they do have warrants. I believe the warrants were just granted to equity holders from the prior from prior to the bankruptcy, and I believe Prescott was focused in the debt, but I'm not 100% sure on that.
So I will just remind everyone, look, we've talked about how UNTC e-liquid stock pink sheets is risky. Warrants are, you take an e-liquid pink sheet stock, and because you're warrants, you're basically just getting leverage on it, right? Leverage to the upside and leverage to the downside. And David identified the one key thing that I look through the warrant stocks. I used to own warrants. I do not anymore, because I'm with David. I think there's an increasing likelihood of a dividend return of capital. And if a dividend is the return of capital, the warrants are, to my knowledge, my knowledge of the warrant docs, the warrants are not going to get that returned. So I just looked and said, hey, like, I love the risk reward of the stock. I think the warrants are probably a fine risk reward, but if I love the risk reward of the stock, why like miss it? Why miss it because of a dividend or something if I'm in the warrant? So again, everybody should do their own advice. I think David laid that out really well. I just wanted to lay out a little of my own thinking too. If somebody hears this and here's the sum of the parts, I think we're going to throw out and says, oh, warrants, let's get that levered upside. There's real risk on top of all the risks we've already talked about. So I just wanted to disclose that. I want to talk some of the parts a second, but you started mentioning the NOLs, the taxes and everything. There was a line that I have thought a lot about in that July press release that pre-announced result said, hey, we've been buying back some shares. We're thinking about more shareholder returns, all that. And the line was this: given the company's growing cash balance, the company is currently updating its calculation of tax earnings and profits. This will be important information which can be used by the board in implementing any future returns, any future plans for return of cash via dividends and distributions in a tax efficient manner. And I think you started to touch on that with the NOLs, but I because that line is so interesting and so unique, I don't think I've ever seen that in a press release before. Just wanted to ask you about that line in particular.
Sure. Yeah. So I think, depending on how they choose to do a dividend, whether it's a special or they sort of, implement a regular recurring dividend, you may be aware, well, you are aware that depending on whether a dividend is, distribution from earnings or return of capital, there can be somewhat different tax treatment, both for holders of the stock and for the company. So we're gonna, I am not a tax expert on that front, so I will again defer that one to readers at home can look at that and understand the differences between return of capital and how that might impact their holdings and where they're holding them in a tax advantage or not tax advantage account. But yeah, my understanding is that, essentially getting to the end of the issue is I think they're going to be paying dividends next as the primary focus to return of capital. The company has not told me that. I'm just speculating based on the NOLs and what you said, the unique wording in that press release.
100% agree. 100% agree with you. And the nice thing, and this brings us to our sum of the parts, the nice thing is that dividend could be pretty big. For the sum of the parts, there's 4 numbers you need. You need their current cash balance. You need to put a valuation on upstream, a valuation on the drilling rig segment, and the valuation on the midstream. And I'll go first just because it's really simple. The company disclosed Q2 cash balance is 115. They're going to get, you have to adjust for the Gulf sale for the cash flow from April to June that we talked about, but they'll get at least $30 million from selling Gulf. I think it's going to be a little higher than that, but let's call it 30 million. So go ahead.
I think the press release said 43.7.
It's 43.7, but then I think they have to adjust. I think they have to adjust for the Q2 cash. Am I misremembering that?
Okay, I thought it was worded and that was the adjustment from the Q2 earnings. I could be wrong. Well,
that would be even better. So let's use your 44 number. It's not going to make a huge difference. Okay. Again, about 10 million shares outstanding, so people can knock $1.40 per share off the numbers if they want to pretty quickly. If we use that 44 number, corporate cash is, let's call it 160 million to make the math really nice and easy. That's $16 per share. So we've got our corporate cash number settled. That's an accounting metric. I think we can all agree on $16 per share. So that's my number I'm going to give to you. You've got to do the other 3 numbers though. Let's talk upstream. What do you think upstream is worth?
Ballpark, I'm still thinking that it's around $1 billion here. They didn't sell it for that. They said in January that's what they wanted. I would guess with where the strip moved, what they wanted also moved. I don't know for sure where exactly that would land today, but my PV10 number back to the envelope right now is around $1 billion. So okay. They went and sold that for around PV10. If the pricing supports it, I think it's around $1 billion here.
So to the extent anybody cares about my thoughts here, I think my PV10 number would be slightly higher. Oh, actually, because I'm not adjusting for Gulf, it would probably be a little bit higher than $1 billion, but I've generally valued everything just in my personal modeling at 80% of PV10. I don't think it's worth super splitting hairs over. People can do that or not if they want, but if you use the $1 billion and it's $100 per share, right? 10 million. If you use the 800 million, it's $80 per share. So again, we're talking to stock trading under 60. I just wanted to throw that out there so people could hear, because this is one of the ones I actually am really interested in. People could hear my thoughts. So we've got your upstream number. Let's go and talk about rigs.
Rigs, yes. So if they were to go sell the rigs for asset value tomorrow, I think I mentioned earlier, I think they would get at least 200 million, probably 300 million for that segment. So $30 a share, $20 a share, pick your number. I think there's a chance they could still get that in a year and cash flow more than $50 million from them in the meantime. So we can use a placeholder and say 25 a share. If you think that, if you start reading the commentary from some of these oil field service operators that are saying they're sold out for 23 already on their rigs, I think that Unit might be able to do upside to that number depending on, again, the pricing environment. We know this whole industry is drill baby drill, even when they try really hard not to. So, yeah, I would say ballpark 25.
Absolutely no disagreement there. And I think I'm with you. I think the valuation is around 250 million or $25 per share. And I'm also with you where I think that's the valuation kind of 1 year from now. And we kind of get 1 years of like super normal profits in the meantime, which probably adds another 40-50 million dollars of cash flow to the business, but not worth super splitting hairs over. So we've now got 3 segments done. We've got upstream, which we said was worth about $1 billion, $100 per share. We've got rigs worth about 250, about $25 per share. And we've got the cash accounting value about $15 per share. Last one, and we could probably do this pretty quickly, but midstream, do you throw any value attached to midstream?
We'll assume it's a zero. I think if the sale process goes through, they sell for 400 million, the unit might end up getting close to 100 million out of that. It could be 50 million, $5 or $10 a share. But my expectation is there's not a ton of upside on this number unless pricing really truly does explode between now and next summer and companies get more comfortable paying a higher multiple on earnings.
Perfect. That makes total sense. So when we just did our math, again, upstream $1 billion, rigs 250, cash 160, net it all out, you've got some of the parts that comes out to about $140 per share. Am I thinking about that right? Doing that math correctly? Yep. Look, I'm totally with you. It's one of the things I've written several times about how all energy looks quite cheap to me. But one of the things I love about Unit is I think you get the best of all worlds. They're returning capital to shareholders. There's no debt, so you're not looking at something where, if prices go down, we're in ruins, but if prices stay here, we make a fortune. Like prices goes down, yeah, we're sad, but because there's no debt and so much of the balance sheet is in cash, you've got a lot of protection there. You've got extra protection from the hedges, which I'm really encouraged that they started putting hedges on at higher levels. So, and then you've got the rigs, which will really benefit if prices keep going parabolic and there's huge demand to drill. So I don't know. Anything else you want to talk about there, or do you think we've covered it all?
Well, I think that the one thing you mentioned that does add some convexity here is the buybacks. They bought back almost 3% of the outstanding shares between when they terminated the process in June and when they put out their press release last week announcing their Q2 preliminary results. To the extent they're able to continue utilizing that and cutting down the outstanding shares, you start doing the similar math to what you just mentioned on a lower share count, and things get pretty interesting. It is worth noting, as we said earlier, with the warrants there, that if we're kind of doing this like $150 a share ballpark over 10 million shares, and there's warrants. So the warrants make it about 12 million right now. I'll be curious to see, if they do a lot of the return via dividends, like we said, then the warrants will share less in that upside. So it's kind of hard you kind of have to game theory how much is going to be buyback, how much is going to be dividends, how much is going to be just getting a multiple on this stock that looks more like other peers.
It's a great point. When I was doing that quickly, I did not adjust for the warrants. Actually, when we originally started buying this, we didn't even know where the warrants were going to get struck, if you remember that, because they didn't announce it and settle it till late June, I think. And then there was like the warrants went publicly traded one day, and I wish I had seen it. The first couple thousand traded for like a penny, which was way too cheap, because I think now they're trading for $12 or something. So, but yeah, we didn't even know. But look, if if unit is worth $1,000 per share, yes, the warrants are really going to matter. If it's worth 140, the warrants are going to matter, but the warrants are struck at 65, which is above today's price. So, cash comes in. It's not like just a straight dilution to 12, but just wanted to point all that out. Let's see. Anything else on unit we should be talking about?
I mean, I think we've covered the main things. I feel like you get, as you said, the best of both worlds here, where, as long as companies continue spending on growth and, they need the rigs, they're going to fill up their midstream assets with product. Their upstream is going to continue to produce. They seem to be committed to hedging it to kind of lock in pretty predictable cash flows on that side. So even if pricing collapses, they're not going to be as sensitive to it here. They've got a huge cash balance. They've got, they've shown a 2-year track record of returning cash to shareholders since they came out of the bankruptcy process. So I think that makes it a stock that really does appeal to the generalist investor that's touring through energy right now, which could be a blessing or a curse depending on where pricing goes from here.
I feel seen by that. I want to ask you one more question about that in a second, but let me ask a random question. Have you read, so Unit was publicly traded for a long time. They went bankrupt in 2020 and they emerged in 2021. Have you read their pre-COVID, pre-bankruptcy filings, hearings at all, transcripts at all?
No, I have not.
Okay. It's really not necessary, but it is funny. So like the last conference they did in 2019, this first quote they come out is they say, oh, hey, we're Unit Corp. We got our start dates back to 1963. We've been here for a very long time. We've seen tons of up and down cycles, and we've been able to navigate them all. And, 6 months later, they're filing for bankruptcy, which it just, every time I think about Unit, I think about that quote, and it really tickles me. I did have a non-unit question I wanted to ask before we wrap this up. You've been super generous with your time. I know we're going over, but look,
sure.
Again, I started following you because you wrote about Unit. That's how I think I discovered you. We've swapped thoughts on several energy names and stuff going recently. I might ask you about WTI in a second, but I was struck. You're a newer firm. You're just coming up. A lot of your book and a lot of your focus is energy. So I just wanted to ask, do you consider yourself an energy specialist at this point? Or is it just, hey, we are generalists, but we are just seeing like with where energy prices are, where the world is right now, there's so much value in energy. That's just where we want to park. That's where we want to place our bets. Does that make sense?
Yeah, no, it's very much the latter here. So I did not go into this year expecting to be quite as heavily concentrated in energy as we've gotten. I was looking at the near-term opportunities of cash flow. You definitely have concerns around where we're going as an economy. In terms of, are we in a recession or going into a recession? What's that going to do to energy demand? We've been focused more on the power generation side as opposed to the oil side. So I think Unit is kind of the only really heavy, well, not the only, it's one of the only heavy, more oil-focused names that I'm invested in. I've got some interesting stuff I've been looking at in coal and natural gas, but have been fading oil a little bit more due to the recession risk there and being a little bit more sensitive. So, yeah, I'm not a traditional energy investor. I am a generalist in the space. So I, as you said, feeling seen earlier, that comment was as much about myself as anything. But
look, I kind of agree with everything you just said in there. Like for me, I think lots of stuff in energy is really interesting. I personally lean towards nat gas heavier things. Unit obviously being one exception, but I lean more towards nat gas heavy things just because coal. I do know how cheap. People ask me all the time, do you know how cheap coal is? I'm like, yes, I can put an Excel model together. I can see LTM numbers versus EV. Thank you very much. But I know how cheap it is. But nat gas, I just think, hey, yeah, you pay up a little bit for it, but I just feel a lot more comfortable with the terminal value, sometimes even the management teams and everything there. But, it's just, I was tweeting yesterday, refiners, right? Just to choose a completely different energy related sector. PBF printed $10 per share in EPS for Q2. It might've been higher. It might've been 12 after you adjust for some tax things. Their stock is at 30. Like this is 3 times 1 quarter's earnings. I know coal, you find a lot of that, and it's like, yes, I get the cyclicality. Yes, I get the terminal value risk, but like, when you're at times 1/4's earnings, there's a lot that can go wrong. And, it doesn't take much to print your whole market cap in 3/4 at that point. So yeah. Anything else you want to say about being a generalist, looking at kind of energy and more commodity focused things?
Yeah, no, I think just in general, it's important to try and, as you were saying, try and understand like what anyone can put these numbers in a model and figure out that they're cheap. So we try to go in with the assumption that a stock isn't mispriced, rather than going in with the assumption that anyone can do the math that I've done on Unit today. So I don't necessarily look at that and think, I'm the only person that's figured this out. I mean, clearly we found each other partially because of Unit. So, that's a great example of generalists finding each other over an energy stock. And, it does lead one to pause and think, all right, what are the ways that I get hurt here? If energy prices collapse, what am I looking at? And that's one of the reasons why I get comfortable with names like Unit, where I know they have hedges in place and I know there's, substantial asset value here, underlying the stock price, where, some of the other names that have been popular, I keep using Sandridge as an example, but I think, I did a Twitter thread on it a month or two ago. If you go look at the valuation of their upstream versus Unit, it makes Unit look very valuable. And so that's another generalist name that's been popular.
Which name was that? Sorry, you cut out for 1 second when you said the name. Which name were you comparing to Unit?
Sandridge.
Sandridge. Yeah. Okay. Yep.
Yeah. I think you just go look at those. You understand. I think sometimes with these names, you can come up with a pair trade that makes sense if you're willing to sit in it for a little while and wait till some of the assets converge their valuation. So we are longer term oriented, and we look at this as an opportunity that we see a lot of these assets as not having fully realized their potential yet, and trading at a multiple that we find too good to pass up, even if, like you said, you beat it up for some pretty significant regression to the mean.
Makes total sense to me. Well, I had a question on WTI, but I think this podcast run long enough and we don't need to get into another super complex, super levered offshore story that time now. So we'll just have to save that for the next podcast. But Dave Bastian, people can find his work, Kingdom Capital on Twitter. I'll include a link to the UNTC piece he wrote in the show notes, so people can go find that. People should give him a follow on Seeking Alpha and everything. But David, thank you so much for coming on. I'm looking forward to the next one.
Thanks, Andy. I really appreciate it.